Hey guys, welcome to the S&P 500 Explained. This is G-Man, and we are going to spend some time today talking about the S&P 500, what it is and why it's important. All right, so let's go. Okay, first a bit of history here. S&P stands for Standards and Poor's, and it's now actually called S&P Global Ratings, so that's the name of the mother company. And what do? They provide credit ratings on bonds. That's their primary business. And so when a company issues a bond to investors, the bond is rated. It's rated AAA, AA, whatever it's rated. And as you can, of course, figure out, a higher rated bond is a higher quality bond, which affects the price of the bond. So without getting into too much of that, which I think we can get into it later on in another module, that's their business. They also publish financial research and analysis, and this is used by analysts, research analysts, and people on Wall Street. The company is about 161 years old, so pretty old company, founded in the 1860s, and the founder of the company is Mr. Henry Varnum Poor. And there's a picture of Mr. Poor, but actually he was Mr. Rich. Henry Varnum Poor apparently was a heir to or part of a family that had some interests in railroads and other businesses up in Maine. So he was a pretty rich gentleman. The company is publicly listed today. The ticker symbol is SPGI. It's got about over 7 billion in revenues. So a pretty big company. Now, there are other rating agencies as well. There agencies called Moody's, Fitch. They're all competitors to the S&P, but the S&P by far is probably the more well-recognized or larger agency out there. So what is the S&P 500? The S&P 500 is a stock market index, and that index measures 500 companies in the U.S. I should say a selected 500 companies. And what does it track? It tracks the total market capitalization of those companies. And what is market capitalization? Market cap, if you remember from Stocks 101 video, is the stock price times the total shares outstanding. And what that really means is that it's the value of the company. So market cap equals the value of the company. So they take 500 companies and they track the value of the company actively daily. And the S&P selects these companies based on their liquidity, their size, and the industry. Some of the requirements: you've got to be at least 8.2 billion in market cap. You have to be based in the U.S. You have to be listed on a U.S. stock exchange. 50% of your fixed assets need to be in the U.S. And you've got to have 4 quarters of positive earnings. So pretty high bar, but if you fit these requirements, then the S&P can select you to be part of this exclusive 500 basket of companies. The index was actually first started in 1923. Back then, there were only 233 companies. The S&P 500, which are 500 companies that we know of, that the index that we know of today, began in 1957. And here are some of the names that are in the S&P 500 index, all names that you're pretty well familiar with. So why is the S&P 500 important? Well, this index comprises of 11 sectors, 24 industry groups, 69 industries, 158 sub-industries. It represents more than 83% of the total domestic U.S. equity market capitalization. What does that mean? It basically means the S&P 500 index is a representation of the stock market as a whole. Since 1968, the S&P has been a proxy for the U.S. stock market performance, and that's why it is very, very important. Now let's take a look at the historical performance of the S&P 500. Here's a graph, and as you can see, it's been pretty good for this basket of 500 stocks. So if you took $100 and you invested it in 1957, that $100 would turn into approximately $54,000 today after 60 some years, right? Now, just a little side note here. The S&P 500 is not constant, meaning the S&P does adjust which companies are part of the index from time to time. So they do kick out companies and they do add in companies. Recent addition to the S&P 500 was Tesla. I'm actually not sure which company they kicked out to make room for Tesla, but point is they make these adjustments from time to time so that the S&P 500 always reflects the market as a whole. That's their goal. Now you can see it's a pretty darn good performance. If we took that $100 and we kept it since 1957, invested in this basket of 500 stocks that they track, and we reinvested the dividends from those stocks, we'd have about a little over 10% return a year, or about 6.55% in inflation adjusted. So over the long term, a pretty good return overall just by investing in the index alone. And essentially what that means is that you're investing in the overall market. Now, the interesting thing about this S&P 500 is that we can actually bet on it, right? So we can actually trade the index. In other words, we can actually buy the market or sell the market. Warren Buffett said, in my view, most people, the best thing to do is to own the S&P 500 index. Why did he say that? Because the index has over time proven to grow and grow at a pretty healthy rate, as you saw in the last slide. Most money managers have a hard time beating that track record. So Warren Buffett's comment is, hey, look, if you're the average Joe investor, why don't you just buy into the market and hold for the long term, because you're going to make money. So what do we call this? We call this index investing. You're buying the S&P index and you're betting on the market as a whole versus buying an individual stock. You're buying the total market. Now, you can do this by buying funds, or you can buy ETFs, which are called exchange traded funds. We'll get into what that is later on. But basically, these funds are a portfolio of stocks that are designed to track the S&P 500 index. So as you can see, Schwab, Fidelity, two very large brokerages and custodians, they have funds that essentially you put your money and you buy a share of the fund, and that fund, their goal is to invest all the money into the 500 companies. Same thing with the ETFs. The SPGI Spider ETF is a very popular ETF that people trade all the time. Now, we can also look at the PE ratio for the S&P 500, right? The price earnings ratio. And remember, we discussed this in the Stocks 101 video. And the PE ratio gives you a measure of valuation or value, how high or low a stock price is. Well, in the same vein, the S&P 500 PE ratio gives you a ratio and tells you where the market is, right? It represents the current stock market PE. Since the index itself is a representation of the larger market as a whole, the ratio for the S&P 500 is an indication for the PE ratio of the market. At the beginning of 2021, this ratio was 38.6 times. And so we can use this as a tool to kind of gauge when we look at an individual stock. We can also say, hey, how does my stock compare to the S&P 500? As an example, Apple, which I always like to use, is trading at 34 times PE ratio versus the S&P, which is traded at 38 times PE ratio. So Apple is valued less than the market as a whole. Is that a good thing? Is that a bad thing? Could be a little bit of both. You can make your decision there. But it gives you, again, when we talked about PE ratio previously in our Stocks 101 video, we talked about it being a relative measure, right? Relative to something else. You've got to compare it. So if you have Apple at 34 times, you've got to compare it to something. And here we compare it to the S&P, which is the overall market, which is trading at 38 times, which is higher. Okay, so I wanted to put this slide in because I know there's some of you out there who are a little more technical and maybe a little more advanced. And I thought this was a really cool chart. It basically shows you a couple of things. The current S&P 10-year PE ratio. That's where we are currently, about 36.3 times. And the historic average, so since the 1950s, the historical PE average has been 19.6 times. So what does that tell you? Number one, where we are today, we are way above the 19.6 times historical average. Now, for some of you who have some knowledge of statistics, we are about 2 standard deviations away from this historic average. So, you know, if you know statistics, you'll know that that's pretty significant. That's pretty meaningful. Pretty rare to have 2 standard deviations away. What does that mean? Does that mean the market is way too high and it's going to fall? Hey, I don't know. If I knew, I wouldn't be sitting here having this discussion with you. I'd be retired somewhere. But point is, this is the data, but again, you're looking backwards, right? You're looking backwards in time. So this is historical data. It does not mean that this won't change going forward. So you've got to decide, you know, what you can make of this information. So it wouldn't be a SKAITUBE video unless we threw in a quick review kind of quiz here. First question, what is the S&P 500 index? And secondly, why is it important? I'm going to take a few seconds to pause here and let you think about that, and hopefully you'll know the answers. Okay, we are back. If you need a few more seconds here, please hit the pause button on the video. Otherwise, there you have it. The S&P 500 tracks the market cap of 500 selected companies. And why is it important? Pretty simple. It represents the U.S. stock market performance, and that's why it's important to pay attention to it. And this wraps up our quick discussion today. I don't want to finish without saying that there are a lot of indexes out there. Dow Jones Industrial Average, very famous index. The FTSE in London. So there are a lot of indices that companies have come up with that people use as a measure of the market. So please look out for those as well. You've got to scope out when the market is moving. You've got to be on top of all of this, and you know, go out there, trade some spiders, play the SKAITUBE gaming channel. It's going to be cool and exciting. You've got another tool now to play. The SPY is a great, I don't want to say stock, fund to trade in and out of, and for you to take a bet on where the market's heading. Thank you guys for being part of the SKAITUBE community, and as always, if there are any questions at all, please feel free to DM me, and I'll do my best to answer those questions. Until then, happy hunting.